Okay, let's get the latest in the markets this morning. Gold hitting a record high. We're joined by Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Andrew, great to see you, and thanks very much indeed for joining us. What a move. The gold bugs have had a great year.
Great to be here, Andy. This has been an amazing year, to put it bluntly, Andy. I mean, cast your mind back to year-end last year, and predictions for where gold could go. We were trading south of $3,000.
Wow.
You know, even if you had said $4,000, you would have been at the far end of the curve. And here we are this morning breaking another record high. And this is holiday trading, Andy. We typically wouldn't expect this at this time of year. In fact, a lot of analysts last week thought that gold could fade in the last 2 weeks or partial weeks of the year. And yet again, we're breaking these new record highs.
It seems to be, though, for worrying reasons, in part concerns about U.S. political unpredictability and the soaring U.S. deficit.
Well, both of those are going to drive this market into next year as well, Andy, because we do not see any relief on the deficit front. In fact, we think the risks are that the U.S. deficit could be higher than what economists believe today. That's going to put upward pressure on gold. And to your point, Andy, geopolitical risks right now, I don't think have been any higher than they are right now, when we've got turbulence now in Latin America, which again, 12 months ago, if you looked at analyst reports, that's an area that we did not think we would see this type of instability, yet here we are. So, you know, analysts coming into the weekend now are suggesting gold could move up to $4,900 an ounce. We've heard calls for 5,000 plus. And after a year like this, it's really hard to kind of put those forecasts out to pasture, because this market looks like it wants to go higher.
Yeah, I mean, the U.S. stepping up pressure on the Venezuelan regime, and then Bloomberg reporting that Ukraine attacked an oil tanker from this famous shadow fleet, a Russia's method for getting oil out. And it did that in the Mediterranean Sea for the first time. I mean, talk about geographical spread of that war.
Exactly. And this is why we think you're going to see this pressure. You know, going into the next year, it depends on what the emerging markets look like. China and India, obviously, as you know, Andy, are key factors in demand for gold. If we see stability in that region or growth in that region, that's going to add to the demand pressure for gold. But we think this flight to safety is going to continue. And let's face it, you know, 12 months ago, we were looking at Bitcoin and gold as, you know, really jockeying for position on a preserve of wealth. Well, take a look at Bitcoin now. Bitcoin is not a preserve of wealth. Gold has really retained that title for investors around the globe.
What about these that we're just looking at Bitcoin way down from its highs, holding its own? It's been sort of in a range lately, a little bit up today, but way down from its highs, all right, of a few weeks ago. How about the U.S. tech stocks, Andrew? Are you overweight or underweight the Mag 7, or can you generalize?
Well, we're basically underweight, Andy, at this point. In terms of the AI story, it's not that the AI story is going to go away. We firmly believe that this is going to be a prevalent technology going forward. But we do think we're at the end of probably the first phase of this story. And that is the phase where, now that we've built it, can we sell it and can we make money from it? And I think we're at that stage now where upcoming earnings reports could be on the disappointing side. And one of the reasons for that, Andy, is really at the end of the day, we've got to sell this stuff to a consumer, or a business has to make something for a consumer. If we are indeed going into a slowdown in the economy or recession in the economy led by consumption, that is going to put significant pressure, we think, on the ability to monetize AI in the near term. So I think we will see some near-term instability. That's not to say the story goes away, but I do think valuations right now are perhaps a little rich based on the fact we need to see results.
Let's maybe put up a one-year chart for NASDAQ 100 as a proxy for tech stocks. It was an amazing piece in The Spectator in London last week. A senior barrister acknowledging that AI was able to prepare a brief that looked pretty well as good as a professional lawyer would.
Yeah, so I guess we should be worried if we're lawyers this morning, Andy. You're going to see more and more of these stories in terms of the capability of AI. But again, back to my earlier point, we have to sell it. We have to make money off it. I spoke to an analyst weeks ago that said, in order for the investments that we've made right now in AI over the last couple of years, trillions, we would have to be charging everybody on the planet $500 per month to use ChatGPT in order to break even. So, that kind of puts it in context in terms of what do we have to make to return, to give a return on equity based on the investment we've made. Again, it's not to say the story's going away. It's not. But near term, I think there's going to be some pressure with respect to making a profit on the investments that we've made in AI so far.
Yeah. And I suppose you might say, well, if workers are going to be fired en masse, who's going to be buying the products and feeding those extra profits?
I think that's the gap, Andy, at the end of the day, when we look at the modeling of what can we expect AI stocks to do over the near term, it really is that, because if we're talking about efficiency gains, which obviously means employment losses, that's going to put a dent in consumption. Again, if we do not have a consumer, at least in terms of the US and Canada, you typically don't have an economy. And I think that's where we have a gap right now in that analysis.
Leave us with a final thought, Andrew. For Canada, what will you be looking out for? The federal government has these massive spending plans. Politicians love to talk about removing red tape, often easier said than done. What do you predict for Canada's economy next year, Andrew? Do you have any thoughts?
Yeah, we're pretty constructive on the economy. And obviously, we've been through a pretty traumatic year for this country, both politically, economically, and globally. We think we're entering a period now where a lot of the policies that have been put in place will hopefully start to pay off. We do like the cross-provincial trade story. We think transports in this country will do well off of that. So I think 2026, again, I hate saying this is going to be a stable year because every time I say that, the year tends to not be stable. But I think 2026 is going to be a year where we look at policies starting to kind of stabilize. We're out of that erratic territory, and I think a lot of the policies in place now will hopefully start to pay dividends. From an economy point of view, we do not see a recession for Canada this year. We think employment will stabilize, and again, depending on what happens with trade. So I think this year actually could be a fairly constructive year for Canada.
Andrew, thank you very much. Have a wonderful holiday and a great 2026.
You too, Andy. Merry Christmas.
Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy.